Over the course of the day, we've debated our infrastructure growth, our welfare architecture, our internal policy resets. But to truly understand if this momentum is sustainable for the next 50 years, we must look at the hard-cold numbers through a global lens. To give us that crucial macro perspective, joining us via live link from the United Kingdom, a renowned voice in international financial markets, global economic advisor to the Equirus Group, Jim Walker. He will be in conversation with my colleague, Gauri Dwivedi. Gauri, over to you.
After that really fiery political debate, we now have someone who's going to talk more about global economics. Well, ladies and gentlemen, we live in an age of permanent disruption, war in the Gulf, oil supply lines that are under tremendous strain, and all certainties of globalization that are almost coming apart, and the world's great powers turning inward. In the middle of all this turbulence, there is one economy that is growing at 7.8%. Yes, that's India. And in fact, my next guest has spent his career calling Asia's turning points, often before the consensus even caught up. He's the chief economist at Alethea Capital and the man behind Asianomics, someone who understands the region very well and often a contra voice as well. Thank you so much, Dr. Walker, for speaking to us on NDTV Ignite. Let's see whether we are able to ignite the screen and really, have that fiery session. But let me start by first asking you, that when you talk about the world that we are in right now at a time when probably the most defining economic story of our times is India. The world is fractured and the only economic outlier right now is India. You've spoken about that bold claim that you made that the next decade belongs to India. Your thoughts on how it adds up, most importantly, in the times that we are in right now.
Yes, I can't promise to be as entertaining as your last two guests. I'm really sorry that I don't understand Hindi because it sounded pretty amazing, and the audience seemed to be enjoying it as well. But, hopefully the audience is enjoying really a transformation of the Indian economy over the last decade, where nobody now looks at India and worries about economic policy making, fiscal policy or monetary policy, even the exchange rate, which of course tends to be a bit more volatile than most of us would like. But policy generally has been in, I think, flight mode, very calm and unturbulent over the course of the last few years, and continues to be, I think, driving the domestic turnaround in the Indian economy that we've seen right up until the first quarter of this year. Now, of course, there is turbulence ahead, which is very much driven by events offshore India. Nothing much you can do about that. But I'm pretty certain that the foundations that have been laid over the last 10 years will see India through this, will improve the prospects for economic growth going forward. And we have certainly no intentions of recommending a change of view to our clients in anything but to be long the Indian stock market. It's much better value today than it was a year ago.
We're almost living in times that feels like end of an era. There's de-globalization, there's complete fracturing of global supply chains, there's decoupling like never before, there's Donald Trump and his massive amount of uncertainty with regard to the global trade order. Your thoughts on, are we looking at a complete reset in the global economy? Or do you think this is cyclical in nature and probably one that we would, I wouldn't say forget, but be able to overcome in about half a decade from now?
Well, there's various answers to that question because there's an element of cyclicality in here, but there's also a structural perspective that we need to take into account. The US at the moment, and maybe it's partly down to personalities, but the lashing out against anybody who stands in its way, I'm afraid is much more an indication of an end of an era than a cyclical event which might be associated with US domestic politics. And what I really mean by that is that there's a change that's taking place in the United States, and it's taking place in Western Europe as well, and indeed in Japan, all of which are what we might call the advanced economies. They're advanced to the point that they've basically bankrupted themselves with their debt levels. The United States is not the worst. Japan is by far the worst in that respect. Europe is following very closely behind in many respects the United States. But what this has done has made politicians in the industrialized countries much, much more nervous about their prospects for the future. And it's all brought upon them by themselves. The politicians have unfortunately promised the earth to their populations. We're in a stage now where what were contingent liabilities for the future, in other words, pensions and social security benefits, are coming home to roost in these economies. Europe is, in a sense, worse than the United States, but the US is catching up very quickly. Japan, as I say, is worst of all. And what that has done has been to begin to bring to the forefront of the market's mind, and I mean in this instance the bond market's mind, the prospect of significantly higher interest rates going forward.
Okay.
And with significantly higher interest rates, we're going to have lower growth. And that's where we're at just now, forgetting everything that's going on in the Middle East.
Which brings me to ask that you mentioned about some of the serious economic headwinds that lie for a US, for the European economy as well as China. Are these economies now heading towards a structurally slower decade? And does that offer a huge and a newer opportunity for India?
Yeah, you know, that they've been slowing already, Gauri, and certainly the case that the United States tends to be the most vibrant of the industrialized economies. But truth be told, its growth rate is around about 2 to 2.5%. Last year it was 2.2%. Cyclically, things will actually slow down going forward, and of course then we've got the Middle East ahead as well. But you know, really the industrialized countries, partly of their own making, as I mentioned earlier, given the debt burden that they've gotten themselves, are in slowdown mode, and there's nothing that can stop that. So yes, this is a golden opportunity for economies outside those regions to take advantage and to move into fast growth mode. China, we've seen over the last 20 to 30 years doing that. Various other countries in Southeast Asia have been ahead of China and then following on from China. And now I think it's India's turn. And I keep saying to my clients, stop thinking about India in Chinese terms, that it's going to be a manufacturing powerhouse for the global economy. That's unnecessary these days. You've mentioned the fact that there's de-globalization, there's decoupling going on. There's going to be much more in the way of unhealthy trade.
Dr. Walker, you've got to think India in Indian terms. You've got to think about the Indian economy in Indian terms. You most certainly cannot compare. You're right that Chinese economic model doesn't work anymore. I want to ask you about the Iran war fog that you've written about. You've mentioned that it is now going to have a huge impact on the global economy as well as India as well. Your thoughts on the kind of impact that we should now really be bracing ourselves for, whether for the global economy and even for India?
Yes, well, we've been in holding pattern, if you like, for the last 3 or 4 months because of the time that it takes for oil flow and oil product flow from the Middle East to arrive around the world. But over the course of the next 6 months, the effects of the war, even if it ends tomorrow, will still be being felt throughout the world in terms of higher oil prices, much higher fertilizer prices, and indeed product shortages. And that's why in our models we're basically saying that the global economy, led by the industrial world, is moving into recession over the course of the next year. Elsewhere, including places like India, we don't really talk about recession as the negative quarterly growth rates, but it's going to be a slowdown for those economies as well, partly driven by higher oil prices and effectively higher inflation generally. We talk a lot about Iran and the Middle East, but we've got to remember that artificial intelligence and the capital expenditure around the world on that is also contributing to very high inflation. And with that, I'm afraid we're heading towards higher interest rates.
Dr. Walker, you're a man of numbers. Any numbers that you could share with us that when you talk about conflict, it is essentially a tax on growth, isn't it? So what are these numbers that we should now be really looking at in terms of inflation, in terms of impact on growth? Let's say it goes on for another 3 months, the war.
Yes, well, it's really going to be determined by the supply shortages. At the moment, the paper markets around the world are looking at oil prices at between $90 and $100 a barrel. I think when you get to actual physical delivery, the prices are much, much higher at the moment in places like Southeast Asia, and it would be the case in India as well, because there are actual shortages taking place. Now, the big problem for central banks is that as those shortages impact and as oil prices and oil product prices rise, inflation will rise. And in the 1980s, the big lesson from that is that even though economic growth slows alongside it because of the shortages, central banks can't sit back and say everything's okay. Those inflationary numbers begin to get into the system and begin to feed through. And that's actually going to, I think, bring Western central banks. The ECB raised interest rates yesterday for the first time in 3 years. America will start doing it over the course of the next 3 months. Japan will raise this month as well. But this is all to address inflationary consequences that haven't actually appeared yet.
Okay, which brings me to ask the case of two central banks, India and the US. Let me start first with the US. There's a new Fed chief in town. Are you then looking at the possibility of the American economy probably going into a stagflation? I ask you this because gas prices there have really risen. And if there is a stagflation-like scenario, do you expect more capital then to come to countries like India?
Yeah, let me address the stagflation question first, because just to give you an example, the US inflation rate for May was released yesterday. That was 4.2%. It seems relatively benign. But when you look below that at 6-month annualized 6.5% inflation, 3-month annualized was 8.2% inflation in the United States. So that becomes a real issue very quickly for central bankers, regardless of what's happening with the domestic economy. So the first response from the central bank has to be over the course of the next few months to raise interest rates. Then they might start looking at economic activity. Yeah. But of course, with what's happening with hyperscalers and data centers and capital expenditure from that angle, things will look not too bad at the top of the overall numbers for GDP, the headline. But underneath, you're seeing a very bifurcated US economy where outside the tech sector, investment is actually negative year on year, and the economy is in the doldrums already. But that inflation is going to be the key force driving economic policy decisions.
Indeed, and it'll be something that they'll have to decide soon, given the fact that there are midterm elections this year. I'm going to leave it there, Dr. Walker. Thank you so much.